5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. Another record. Global equity hits a new high as the EU and U.S. progress towards a trade deal. And Elon Musk warns of a few rough quarters ahead after one of Tesla's worst earnings results in over a decade. And a win for Alphabet. Sales get a boost from significant AI demand. So how your indexes are performing this morning really depends on how much Alphabet you have and how much Tesla you have. It's Alphabet up, Tesla down in the pre-market, and it is little change for the S&P, while NASDAQ 100 futures outperformed by about 0.3%. It is this hope that we're going to get a 15% tariff on the EU, that is the baseline, that we will get an agreement. Scott Bessent saying yesterday that there was progress towards a deal with the EU. Now, for this bond market, it is a second day of losses, at least how we are headed this morning. Though little changed, I should say. Attention for this bond market will turn to an ECB decision in about 3 hours' time. But yesterday it was a 20-year auction. That was smooth sailing. Your 10-year yield, that stands at 4.38 this morning. Let's get some stocks moving this morning. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start with Alphabet. Beats across the board in its cloud revenue, in its Google ad revenue. It also went on to increase its CapEx guidance an extra $10 billion. Alphabet shares up some nearly 3%. It's also giving a boost to some chip makers, Danny, the likes of NVIDIA and Broadcom, also trading strongly this morning. Let's move on to Tesla because there is a bit of disappointment there. The CEO, Elon Musk, warning of tough times ahead. This comes after their results showed a steep drop in revenue, and they basically posted one of the worst quarters that they've had in a decade. So Tesla shares have been sinking further in the pre-market, down 6.2%. Let's end on a positive note. European banks doing very, very well, out with earnings from BNP and Deutsche Bank. Both of these names, big beats when it comes to fixed income trading revenue. We're seeing the stocks in the green off the back of that. Deutsche Bank, one of the best performing stocks in Europe this morning, up some 6.4%. Danny.
Valerie, thank you very much for that. We'll catch up with you later in the hour. Also this hour, a great lineup for you. We're going to be speaking to RBC's Elsa Lignos on FX, Jim Zenni of ZCG on private equity giants and the industry, and Stephanie Brinley of S&P Global on Tesla. Back to trade, though, our top story, President Donald Trump's tariffs may now have a floor. He suggested that rates for nations that aren't in line for a trade deal would not drop below 15%.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple of we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is.
For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, does it look like the EU might be getting that 15% floor?
Well, the mood sounds optimistic from both sides. As you said, Treasury Secretary Bessent said things are moving in the right direction. And the real sticking points for the Europeans are these sectoral tariffs, the ones on autos and steel and aluminum. And Japan seemed to break through on at least autos. And so that was a significant concession on the U.S.'s side. And so the EU would be looking at something like that and saying, you know, we could live with a deal like that potentially. But of course, there are other sectorals, steel and aluminum, pharmaceuticals, and chips that the European Union would want some visibility on. What are they going to be paying eventually when those tariffs come into effect? We also have South Korea, which has some talks ongoing over the next couple of days. They would be looking at a similar deal to what Japan got, because they're, of course, a large auto exporting nation, a steel producer as well. So 15%, the reciprocal rate, as well as some relief on those higher sectoral rates, the 25% on autos and 50% on steel and aluminum, seem to be on the table as well. So the European Union would be fiercely negotiating something along those lines for themselves.
And there's this question as to whether all of this pushes the EU towards China. Brendan, you had flagged to us that this week we're getting one of the first meetings, at least in person for some time, between Chinese and European leaders. And on that, Ursula von der Leyen told Xi Jinping that the ties between the two are at an inflection point. What is that inflection point, Brendan?
Well, it's at an inflection point because the EU's biggest trading partner after the U.S. is China, and they depend on each other a lot of interdependencies in the same way the U.S. depends on China. But China is violating a lot of the the old rules of the global trading system with overcapacity. It's hoarding of rare earth minerals a few months ago, and that just raises the concern in Brussels that China is working against the European Union. So this summit this week between Brussels and Beijing is an important point at which they're going to try to reset those on a positive direction instead of the sort of deterioration that they've been on for a couple of months.
Brendan, thank you very much for that. That is Bloomberg's Brendan Murray. And despite more trade deals and more progress, it's a dollar that's either fallen or reacted little. That's the reaction this morning. We're joined now by Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Elsa, I wonder what you make of that. After a trade deal was inked with Japan, it was a dollar that fell despite front-end yields moving higher. What does it tell you about the direction of where we go from here?
And I think there's a broader theme of dollar weakness that nobody is willing to give up on, and for good reason. The dollar is coming from a very strong starting point. We know for a very long time global investors have been overweight US assets and underhedged on those assets, and that's part of the process that's unwinding now. And so almost regardless what happens on the tariff front, that's a dynamic that would be playing out in any case, and has further to run.
Does that dynamic, though, pause with U.S. equities at an all-time high? Elsa, it seems that this is a market that investors are happy to jump back into at the moment.
Yeah, I think that's a fair point. There are two sides to this dynamic. One is the hedging on existing assets, and the other is rotation out of U.S. assets into rest of world, in particular European assets. The latter really took place in the first quarter of this year. You saw that very strong surge into European assets, particularly after the German fiscal announcement. But that actually didn't follow through in the second quarter, and the early signs from Q3 similarly are not as strong. Whereas the hedging dynamic, the change in behavior around FX hedges on existing US assets, that is underway, and that I think has further to run. Because, we haven't even seen the Fed start to cut rates yet.
And of course, that is one of the risks, not the Fed cutting rates, but what's happening at the Fed and the threat to Fed independence with Jay Powell. President Trump is set to visit the Fed building at 4 p.m. for about an hour today, local time. Jim Bianco, Bianco Research, writing, if they want to find reason to fire him with the building renovation, they could, because every D.C. government building renovation tends to be rife with mismanagement and cost overruns. Elsa, is this a real concern for this market, or is it something that, as Trump continues to brush it off, saying that they won't fire Powell, is just palace intrigue?
It's something people certainly have on their radars, and with good reason, right? But at the end of the day, Trump's term as chair does end in May of next year. And I suspect that Scott Bessent will be strongly advising Trump against going down such a route. You hear Trump saying, well, if rates were at 1% rather than 4%, we'd be paying so much less interest on our debt. It's not true, right? Because the Fed controls the front end, the market controls the back end. Unless, they have talked about shortening the duration of debt and so on. But at the end of the day, it's a dangerous path to go down to question Fed independence like that. And I suspect that the more rational voices within the administration will probably win out on this, not least because there's not that much long to go until Powell's term ends as chair.
Even so, when you heard from the Commerce Secretary Howard Lutnick yesterday saying that Powell should resign or called for him to be replaced, there was a clear reaction from the dollar. Elsa, what do you make of the sensitivity of the currency market to this?
Absolutely. Central bank independence is a core tenet for DM central banks and even increasingly EM central banks since the late 90s. So when that's called into question, it's part and parcel of this broader questioning of the institutional framework that we had grown accustomed to in the US that appears to be being questioned under this current administration. I would say, though, that it's pushing on an open door to some degree, because the Fed was already on the path towards cutting rates and was already on a starting point with very low hedge ratios that did have to increase. And so what we're seeing at the moment is a dynamic where those hedge ratios are just naturally going up in anticipation of those cuts, whether or not they're sped up by, palace intrigue, as you called it.
Well, at the same time, we're going to have an ECB decision later today, Elsa. Widely expected no change. But we have heard from various ECB officials, de Guindos being one of them, saying, I am looking at the currency. If it goes to something euro-dollar like 120, that's when we begin to get worried. At what point does a stronger euro start to tilt the balance in favor towards another ECB cut?
It's an interesting question because I think there are varying opinions within Governing Council. And you've heard comments like that from de Guindos, but at the same time, other Governing Council members see the strength of the euro as a sign of the optimism surrounding the euro area and investment into the euro area. I mean, I would say that it's not just euro-dollar. We tend to focus a lot on euro-dollar in markets. It makes sense. But the one thing we've been looking at RBC, in particular with our European rates and economics team, is euro-renminbi. The fact is that as the renminbi has kept pace with the dollar on its path of decline, euro-renminbi is at the highs, and so trade-weighted euro has strengthened quite a bit. That's got more meaningful economic impact. I do think the ECB will be watching that, but I don't think we're yet at levels where it's going to change their approach to policy setting or push them into a rate cut they wouldn't otherwise be delivering.
Elsa, really wonderful to catch up with you this morning. Thank you so much for joining. Elsa Lignos of RBC Capital Markets. Let's now get you some other stories that are trending on the terminal this morning. Tom Hayes, the former UBS trader, cleared of manipulating LIBOR by UK judges, says the other traders convicted to rigging interest rates should have their cases overturned. Hayes spoke with Bloomberg's Anna Edwards earlier.
Never put rates forward as submissions or asked for rates to be submitted that were false. Were they commercially influenced? Yes. We can have a morality trial about that. That was a system. The benchmarks were set up by the banks for the banks. The whole thing was just badly set up. And it's all very well after the event 10 years later to say, well, we don't like the look of this and somebody's got to go to prison for it. But no one lied.
And as you mentioned earlier, President Trump will visit the Federal Reserve in person today to tour a construction site that he has criticized for cost overruns. The president's daily public schedule released by the White House notes that the visit is planned for 4 p.m. Eastern. He has been attacking Fed Chair Powell for not cutting interest rates. And Goldman Sachs has decided against a second round of performance-based job cuts this year. That's according to the FT. This comes after a better-than-expected recovery in investment banking. The lender has declined to comment, the report said. Coming up, a tale of two quarters. We're going to recap earnings from both Tesla and Alphabet as their fortunes pre-market diverge. You're watching Bloomberg Brief. Let's get a check on Alphabet shares this morning because they are moving higher in the pre-market by 3%. A beat in the second quarter results. Let's get into those numbers with Bloomberg's Shirley Zhao. Shirley, what was your takeaway?
So Alphabet's result for the second quarter was mainly boosted by increasing demand for AI. Revenue from the company's cloud computing business, which includes the AI model Gemini, exceeded analysts' expectation due to rising demand among the mass market as well as among the enterprise clients. And because the market is so big and there is no lack of competitors in this market, we've seen companies like Microsoft and OpenAI and Meta all investing more and more in this area. So Alphabet has to invest more as well to keep up its edge in this market. Already, we've seen many people using chatbots to replace search engines, and that's creating a lot of pressure on Alphabet's flagship search product. So increasing investment is necessary for Alphabet to further grow its business.
Yeah, and that investment increasing first concerned investors, and then it seemed to turn around. Shirley, we're also going to get second quarter earnings from Intel after the bell today. What are we expecting?
So Intel is in the middle of an effort to turn around its businesses, and its new leadership has said that it needs more time to fix some of its problems, including a rather stale product lineup, and to get more orders for its factories, and to get more competitiveness against companies like NVIDIA in AI chip making. And I think a lot of investors would want to know more details about these plans and the company plan to improve its revenue and profit. Some investors are concerned about the second half of the year in the personal computer market, which provides the majority of revenue for Intel. That's because there seems to be a rush for customers to make purchases before President Donald Trump's tariffs take effect. And that may mean that demand may dip in the second half of the year and affect the company's earnings.
It's a pull forward effect we've seen across many industries. Shirley, thank you very much for that. That is Bloomberg's Shirley Zhao. Now, shares of Tesla, on the other hand, are sinking in the pre-market trade this morning. The EV maker saw one of its worst quarters in over a decade.
We probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2. But once you get to autonomy at scale in the second half of next year, certainly by the end of next year, I think I'd be surprised if Tesla's economics are not very compelling.
Joining us now is Bloomberg's Craig Trudell, who leads our global autos coverage. Craig, what distinguishes between a period of transition and just a rough patch?
Yeah, I think that's the question, right? I think in addition to just the real concern, legitimate concern about the demand outlook that I think Musk was a little bit more honest about last night than we've heard him be in the past, the sort of outlook for this autonomy at scale, as he put it, is clouded by the fact that, back in 2019, he said Tesla was going to get there in 2020. So, you have to sort of take him at his word that he means it this time when he says that, Teslas will actually be capable of autonomous driving. And this is something that, he not only has to prove to consumers, but to regulators. And I think that was part of the sound we just heard from him, was this idea that, part of why he's sort of alluding to the idea that Tesla may not be able to scale so quickly is regulatory approvals, which, here in Europe, not only are they not able to put driverless vehicles on the road, they can't even deploy full self-driving to their customers, a driver assistance system.
Yeah, and a lot of the timelines have been squishy, Craig. Craig, thank you very much. That is Craig Trudell on Tesla. Now, along with more earnings this morning, we're also waiting a rate decision from the ECB. We are live to Frankfurt, where Lizzie Burden will have the preview for us coming up next. You're watching Bloomberg Brief. I'm Dani Berger in New York. It's ECB day with a decision just under 3 hours away. The central bank is expected to leave rates untouched at 2% after a cutting cycle that's lasted over a year. Joining us now is Bloomberg's Lizzie Burden on location in Frankfurt. And Lizzie, this decision off the heels of reporting that it seems like the U.S. and EU are more closer to a trade deal. How does that change what we might hear from the central bank this morning?
Well, Dani, for some economists, that would mean that you don't need any more cuts from the ECB this year. But I was speaking to our economists at Bloomberg Economics last night, and they say that even if you had a 15% tariff deal, following in the footsteps of Japan, it would still be higher than that 10% levy that was baked into the June forecast, which suggested that you'd still need one more cut from the ECB this year, and then you've got to layer on the sectoral tariffs. So our economists would still see cuts in September and December, even if you got a 15% tariff deal. I asked them as well, what would happen if you got no deal? Because, of course, 30% tariffs weren't even in the ECB's most severe scenario in June, and they say, interestingly, that you may not even have that different a picture, because while you have the disinflationary impact of US tariffs, you'd have the inflationary impact of the EU's retaliation. So you could still see two cuts in September and December. All of which to say, Dani, is there's a lot of uncertainty out there. By September, hopefully they'll have more clarity on trade, definitely more data, and crucially more forecasts. So that's precisely why all but two economists in our survey say today they're going to hold.
One of the other dynamics that's unfolded with this, Lizzie, in the uncertainty, as you say, is a dollar that keeps weakening and a euro which has been strengthening. What's Lagarde likely to say on that?
Well, of course, as you well know, that euro strength is largely a dollar weakness story, and that largely comes down to the president's threats on the Fed chair, which Joachim Nagel, the Bundesbank president, has commented on. He said that you could see global ripple effects of that meddling with Fed independence. But the euro's up 13% against the dollar so far this year. It's going to come up at the press conference. I wouldn't expect Christine Lagarde to go as far as Vice President Luis de Guindos in pointing to 120 as the level that is the complicating level for the euro area economy. But let's see how much she emphasises how much it's feeding into the disinflation story, the euro strength. Let's also listen to how much she is more humble, shall we say, than at the June meeting about how good a position the euro area economy is in. If she emphasises the downside risks to growth today, then many in the market are going to interpret that as a signal that the door is open to a September cut.
Lizzie, really appreciate that. That is Bloomberg's Lizzie Burden. Again, we're going to get that rate decision about 8:15 here Eastern time from the ECB with a press conference to follow from Christine Lagarde. All right, coming up next, we talk about private equity and deal making. We'll speak with James J. Zenni Jr. of Z Capital Group on this environment. That's coming up next. This is your Bloomberg Brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. Another record, global equity hits a new high as the EU and U.S. progress towards a trade deal. Elon Musk warns of a few rough quarters ahead after one of Tesla's worst earnings results in a decade. And a win for Alphabet, sales get a boost from significant AI demand. So here we are gaining, depending on what index you look at, after another record high for the S&P, a record high for global stocks fueled by headlines that the U.S. and EU are closer to a trade deal. But the results will vary on what index you are, depending on how exposed you are to Alphabet and to Tesla. Tesla down sharply this morning. Valerie will get into that in a moment. But NASDAQ 100 futures outperform, up 1/3%. For the bond market, it is yields mostly higher for a second consecutive day, up just about a basis point for a 10-year yield at 438. It was a smooth 20-year auction yesterday. Focus now turns to an ECB decision in less than 3 hours' time. Let's get you those stocks on the move this morning. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with the positive news from the Mag 7s, and that was Alphabet's earnings report yesterday, coming in strong, beats in their cloud revenue and also beats in their Google ad revenue as well. The one key thing here, though, for broader markets is Alphabet is increasing its CapEx guidance another $10 billion. That's seeing Alphabet rise some 3% in the pre-market. We're also seeing chip makers in the green as well, such as NVIDIA and Broadcom, really liking what they hear from that extra CapEx spending. Let's move on to the more negative news from the Mag 7 earnings last night, and that is Tesla. Pre-market Tesla down over 6%. This comes as their revenue saw a very steep decline in the quarter, one of their worst quarters for their performance in this decade. The CEO Elon Musk also warning that this is not just the end to the tough quarters. He sees a few more ahead for the EV maker. Let's end in Europe. We did have some solid earnings from the banks. BNP Paribas and Deutsche Bank both posting beats in its fixed income trading unit. Deutsche Bank coming in with a decent beat, up 7% for Deutsche Bank, one of the best performing stocks in Europe this morning. Danny.
Valerie, thank you very much for that update. Now, another set of earnings we are going to be getting today is Blackstone, with the big private capital giants kicking off earnings. It'll be reporting before the bell as the sector deals with a tough first half. In the first half of 2025, deal making took a major dive as a result of uncertainty in the markets. Joining us now, I am pleased to say, is James Zenni Jr., founder, president, and CEO of Z Capital Group, which has investments across private capital strategies with about $4 billion of AUM. Jim, thank you so much for joining this morning. Really wonderful to see you.
Thank you.
And look, it's probably a period that a lot of your peers maybe would want to forget as a really tough deal-making environment. In a period that's been marred by dislocation, what's your read on how well this industry has coped with it?
Well, I think there's a lot going on. Obviously, a lot of the discussions around realizations, lack thereof. If you look at the data since the financial crisis, there was sort of during that time period, there was about 40% of net asset value that was returned annually. Now we're in the 10% range. Roll forward, call it 20 years from now. So we're really sort of at a record low as far as distributions to investors, which is very topical these days. And that has sort of spawned the whole secondary market for continuation funds. In some cases, they're continuation funds squared, where it's actually a redo of another continuation fund, which I think is actually going to be something that's going to be a big business going forward. You're going to see, in fact, the last 6 months, year to date, the amount of secondary flow deal making, new funds, was about $100 billion. 40% of that was continuation funds.
So for a lot of funds, though, there's been this idea that they're just in this period of extend and pretend, that they maybe bought assets before interest rates really started to go higher, they overpaid, and they can't find buyers for what they want. For those that are doing that right now, are they about to almost get a get out of jail free card? If we are going to get rate cuts later this year and early next year and things like tax benefits from the one big beautiful bill, are we about to get this period where the jamming up of markets comes unstuck?
The thing that's not being discussed, and you could argue whether the Fed should cut rates or not, what's not being discussed is the high capital cost. Deal making, the L and LBO is leverage, and deal making is completely dependent on the cost of capital. So prices of transactions, multiples to EBITDA, have not gone down enough. And basically, you've got a logjam of deals to do, either for sale or to buy. But the problem is if you run traditional LBO models, the capital costs are very, very high. And it's hard to justify making acquisitions with high cost of capital. And think about it. Our balance sheets, were basically put in place, or debt structures 4 or 5 years ago. And now interest rates are higher. So all private equity firms are getting squeezed on free cash flow because of higher interest rates. And you can't reinvest in the business in that case.
Well, one of the things that we've seen a lot of the big players do, and Jim, ZCG is really among them, is branch out. And you've been doing this for some time, but not just do private equity, but have private credit in your arsenal and other strategies too. Does this mean that the business model has changed going forward, that if you're a smaller, pure private equity player, that you will struggle to exist right now?
I think the answer is it has to. I mean, if you look at traditional private equity, started back in the 80s, and the key really is where are your returns really being driven from? Is it just financial leverage, or is it actual operational expertise and resources? And in our case, we've developed a whole consulting practice internally. And we also have a technology affiliate that drives a lot of value through tech enablement in a variety of ways. That wasn't whiteboarded 20 years ago. But over time, you realize you're deficient in some of the toolbox tools. And we've developed, and very fortunate to have these, and you have to have resources today to drive value, and you've got to assist and work with management teams to optimize their businesses. And we just happen to have a pretty interesting business model today.
I would love to know, because I know a lot of the in-house consultants and your exposure with different companies is some kind of consumer-related companies, and we've seen a bit of an unevenness in earnings. Coca-Colas of the world are able to rise prices. The GMs of the world absorb those price increases from tariffs. What have you seen? Is this a consumer that's still willing to pay more, or are you seeing pockets of weakness?
I have a really interesting seat in the sense that I sit both on the IC of our credit business as well as I head it on the private equity business. So I see a spectrum of businesses. Specifically in private equity, we're in a 10-11 industry. So I see a spectrum of what, from manufacturing to consumer. The consumer trends have changed dramatically during COVID and then post-COVID dramatically. And there's winners and losers in that scenario. Consumer is, especially on the lower end of the economic spectrum, very, very picky as to what they're spending their money on. The shift has been to things like experiences, things like we have a company that supplies medical supplies to the maritime industry. Cruise business is exploding because of the experiences. And it's a relatively inexpensive vacation. So we're seeing a mix of haves and have-nots. On the other hand, you are seeing, consumers, yes, they're being picky, but they're also looking at value as well. It's not just what's the cheapest price.
Jim, before we let you go, I would love to get your take on private capital in 401ks and the administration making changes and potentially allowing things like private equity to be in retirement funds. Does it make sense to you for this to be the wrapper of assets that are more risky and less liquid?
I think if they're properly disclosed, if they're properly marketed, I think certainly it makes sense. I'm surprised it hasn't developed earlier, to be honest. It is a windfall for the industry. The big guys will take advantage of it earlier. Good for them. But I think it's inevitable. It's going to happen.
Can I just get your thoughts on that? If it is a world that's shifting more towards wealth, more towards retail, how do you compete with the big guys that have crazy marketing forces that can go out there and try to capture that?
That's an interesting question because it to some extent, especially the public companies, which are great businesses and super success stories. But we have a bit of an advantage in the sense that we don't need to go out and raise tens of billions of dollars to be effective, right? We're in the middle market space and can do very well with billions of dollars of funds. The larger guys have it harder because they have an AUM story when they're, as you mentioned, Blackstone's earnings. They're a little bit in a different business today as a public company. In our case, we're just fine raising X number of dollars to execute on our strategy. So to some extent, it's a little easier for us. The other thing is you're seeing the secondary activity, which I mentioned. Most of that activity, if you look at the portfolios of those sales, most of it is on the large cap private equity funds. In fact, I was just with a CIO of a state fund the other day, and they're arranging a sale of some of the larger names, selling down and reducing exposure. And there has been a shift to sort of the middle market space. The theory there is that it's just less competitive, and and if you have the right tools, you can drive returns.
All right, Jim, we're going to have to end it there. This has been so wonderful.
Really good to see you.
Thank you so much for joining. Wonderful to see you as well.
Thank you.
That is James J. Zenni Jr. of Z Capital Group. Let's quickly now get you some other stories that are trending on the terminal this morning. And President Trump will visit the Federal Reserve in person today to tour a construction site he has criticized for cost overruns. The president's daily public schedule released by the White House notes that the visit is planned for 4 p.m. Eastern. He's been attacking Fed Chair Jerome Powell for not cutting rates. And Columbia University has reached a deal with the Trump admin to restore federal funding for research. The school will pay a $200 million penalty over 3 years to resolve civil rights investigations in order to restate the majority of more than $400 million in canceled grants and contracts. And the FT reporting that Goldman Sachs has decided against a second round of performance-based job cuts this year. This comes after a better-than-expected recovery in investment banking. The report said that the lender has declined to comment. Coming up, a rocky road for Tesla. Shares dipped more than 6% this morning, with Elon Musk warning a rough patch ahead. We speak to Stephanie Brinley of S&P Global Mobility. That's coming up next on your brief.
We probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2. But once you get to autonomy at scale in the second half of next year, certainly by the end of next year, I think I'd be surprised if Tesla's economics are not very compelling.
One of the worst results for Tesla in over a decade, and those comments there adding to the decline in shares this morning, more than 6%. Joining us now is Stephanie Brinley, Associate Director of AutoIntelligence at S&P Global Mobility. Stephanie, great to see you. And look, we didn't exactly see the few rough quarters translated into any formal guidance. So what is your assumption as to what this period actually looks like for Tesla?
Oh, I think it still does look like a bit of a rough period. While he's focused on the robo-taxis, the sales were not doing as well as they would have liked. They're down from last year, up from last quarter, but last quarter was quite difficult as well. And I thought it was interesting that it was one of the the rare quarters where they produced significantly more than they sold for Tesla. It was about 76,000 units more that they produced than they sold. And traditionally, their production and delivery numbers are much closer than that. And I think there's still some softness in the market for the vehicles right now.
But the executives on the call, Stephanie, spent relatively little time talking about EVs. Instead, to your point, it was about robo-taxi. It was about a new Tesla diner. In order for Tesla to get and continue to have the valuations that it currently does, is this a Tesla that needs to convince investors that it's not a car company, and has it successfully done that?
Oh, I think that it needs to convince everyone that the robotaxi is going to deliver in the time frame in terms of the financials that they want. Whether it does or not is remains to be seen. It's certainly great technology. It's certainly technology that is being explored by a number of companies in a number of places around the world, but we haven't got to a commercialization point that actually demonstrates the profitability yet, and that's probably still a little bit elusive.
How troubling is it to get those deadlines? I mean, there's some bold ones. Expand a robo-taxi service in a couple weeks is what Musk said. A cyber crab in production by 2026. Having people able to add their own Tesla to a mobility fleet by next year. Autonomous ride-hailing service by the end of next year. Stephanie, these are really big projects. And he's given himself a timeline of about 1 year. What happens if we don't get them in that time period? And we know timetables and deadlines tend to be a little bit squishy for Tesla.
They do tend to be squishy. I think that it'll be difficult, especially if you're looking at what the market does in reaction to it. But the company's been valued high for a long time. And, you know, when we look at this too, he always keeps, and rightfully so, has to point out that, you know, all of these ambitions have a lot to do with regulatory issues, and not necessarily addressing kind of what those are going to be or how hard they're going to be to get over. One of the things that I think is interesting is what is it really going to look like from a regulatory perspective when you start having people add their own vehicles to the robotaxi network? You know, is that easy? What are our governments going to want to see on a state or a national level before you're doing that? They did address some of the concerns that might come up in there, and saying that to have a vehicle on the network, you would have it checked out, you would have it approved and reviewed. But there's a lot to unpack there, and I think that what we might find is that the appetite for robotaxis is there, but to have it develop as much as he needs in the next 12 months might be a bit of a stretch.
Stephanie, as we're talking about regulatory impacts and trying to get approvals for things, how much damage has there been done from Musk's foray into politics? And of that damage, how much of it is irreparable?
Well, that's a tough question. I think that it's been fairly significant. You know, what I would like to see out of Tesla in some ways is actually to behave a little bit more like a car company, in the sense that they're addressing product issues a little bit more directly, and really trying to figure out how to sell cars. That doesn't seem to be a priority, and that's been fairly consistent for the company in some respects. And it's always been the next technology. It's always been something else to look forward to, and you need that. But the fundamentals of the basics aren't really there. And in the sense of trying to expand your car market, you aren't expanding product lineups all that much. The changes are incremental, and consumers don't always respond to incremental change in the way that he expects them to. I'd like to see a little bit more of the car company, and it pop up a little bit.
Stephanie, judging by the reaction to the results, I don't think you're alone in that. Thank you so much for getting up early for us and joining us, Stephanie Brinley of S&P Global Mobility. By the way, Dan Ives writing on Tesla with solid progress with autonomy and AI future. Musk is now acting as a wartime CEO. Well, Tesla wasn't the only set of results we got after the bell last night. We also got Alphabet. Those shares are rising 3.5%. It demonstrated strong demand for AI that helped boost sales. But now that requires more spending to keep up with competitors. Joining us now is Matt Bloxham of Bloomberg Intelligence. And Matt, here you saw shares waver at the beginning of the announcements, whether it's more important that they're advancing on AI or spending a whole lot of money to do it. What was your read on the dichotomy between the two?
Yeah, I mean, also it's a big move. What, $85 billion of capex this year, so that's about 45% up from where estimates were at the beginning of 2025. So it's a really big move. I think one of the reasons we're seeing the positive reactions so far is they talked to a growing order book from their enterprise customers on cloud, and so I think that there's perhaps some confidence that the investment they're putting into AI is actually supporting real demand that's coming through. And I think we saw their cloud business actually post better than expected profitability, and that's been a bit of a sore point for many quarters in the past. I think the other aspect here that's perhaps encouraging is obviously the big worry about Google is whether their search business, which is really the core of their revenue right now, is under threat, or how big the threat is from AI-based chat alternatives. I think actually what we saw a beat across the board for Google this time, including a better than expected search revenue number. So I think that was also reassuring that if there is going to be a threat to that search business, it's not coming through yet. And again, perhaps the investment they're making is a good way for them to kind of strengthen the moat they have around that business.
I just wonder if at some point this ends in terms of investors being okay with all the spending that's happening, because it's not just Google, it is Meta too. We're going to get their earnings later in the month, spending enormous amounts, not just on AI itself, but on the talent around AI. Is this an investor base that's patient?
It's a question of patience, and I think also uncertainty. You're right to question whether these huge capex numbers are ultimately going to pay off with real returns on investment. But I think it's a pretty stark choice for all these businesses. If you don't spend the money and keep up with your rivals, then you're essentially waving the white flag, and that would have an even bigger detrimental effect on your share price. So I think these are kind of essential investments that they're all making to stay in the game.
All right, shares up just under 3.5%. Matt, thank you very much. That is Matt Boxham of Bloomberg Intelligence. Coming up, we're going to get you set up for your trading day, including President Trump's visit to the Federal Reserve. We'll have your trading diary for you next on The Brief. Let's get you set up for your trading day. First up, we have an ECB rate decision that comes at 8:15 a.m. Eastern. Then jobless claims at 8:30 a.m., followed by PMIs at 9:45. Then we also have President Trump, who's scheduled to visit the Federal Reserve construction site at 4 p.m. We'll see if that brings anything with it. Now let's get some individual movers this morning. Tesla falling after Musk warned on the earnings call that they're going to face a few rough quarters ahead as they try to transition from EVs to robo-taxis. ServiceNow, those shares up 7%. Earnings, that was a beat and a raise with subscription revenue forecast. And Chipotle, shares down sharply. It cut its sales forecast for the second time this year. So those shares are down just about 10%. All right, that is it for your Bloomberg Brief surveillance. We'll take things ahead from here on this Thursday. You're watching Bloomberg.